once the COVID shock passes and things start to go back to normal and workers fully return and demand goes back to normal, I don't see any reason why the economy wouldn't revert back to the low inflation regime that we've been in for 20 years.
I think that over the next 2 to 3 weeks, we will see a drop off on this. So everything is under control. It's not as crazy as you would think.
Together with the Plan B measures that we introduced before Christmas, we have a chance to ride out this Omicron wave without shutting down our country.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. The great rotation, investors flock to value over growth at the fastest pace since 1995, sending the Nasdaq plunging. Riding out the wave, while the UK and France report record virus cases as governments bet they can weather the surge without tighter rules. But Hong Kong adds new restrictions. And OPEC and its allies agree to increase oil output. Demand is expected to withstand Omicron. So, good morning, everyone. First thing is first, let's check in on the markets. A little bit directionless. We're certainly trying to look at a number of factors, various asset classes, and I would also suggest various parts of the world playing catch up depending on where they are in the economic cycle. But the one thing that's reading across all markets is, of course, that sell-off in technology stocks. This has to do with how many times the Fed will hike and what it does to valuations. Today, the big one to watch out for, FOMC minutes. They will give us a good indication, actually, or at least investors are hoping they could give us a good indication on whether the Fed will hike 3 times, on how aggressive they could be, and the timing also of that first rate hike. I'm looking at Brent on the back of OPEC. You can see $79.75. This is a map for Europe. A couple of things that we need to watch out for. First, the first subordinated syndication debt in Italy. They're trying to take advantage of some of these lower borrowing costs. Certainly, before political turmoil could grip Italy, it's January 24th that we had confirmation that there will be a new president. The question is whether it's Mario Draghi. Does he have to leave as prime minister to become the president? That probably won't be good news for markets overall. You can see the FTSE, the CAC pretty much flat, trying to find a direction as they look at technology stocks and yields in the U.S. And then the DAX over in Germany gaining some 0.2%. So growth stocks selling off, the biggest New Year rotation since 1995. On Fed rate hike expectations. Tech, as we were saying, in particular suffered with the Russell 1000 growth index also down more than 1%. Well, let's get straight to Roger Jones. He's head of equities at London and Capital, joining us now as well. Christine Aquino from our FX and rates team. So thank you both for joining us. Christine, let me start off with you. What does a tech sell-off tell us about what the markets are looking at right now?
Well, Francine, I think this is very much consistent with the environment that we're seeing at the moment, which is higher yields and more concern about inflation at the onset of 2022. And of course, these sectors in particular have been highlighted by investors at the end of the year as some of the frothiest sectors that could be vulnerable to an environment where yields are rising, rates are rising, and inflation concerns are also on the rise. And we're definitely seeing that play out. As far as today is concerned, very interesting that we're seeing the sell-off very globally from the U.S. to China in the Asia session and a little bit here in Europe as well.
Roger, are you expecting a sell-off in equities just because it doesn't seem that there has been a correction if you look at what's priced in the markets with 3 Fed hikes in 2022?
Yeah, well, I think we're definitely at the point where we're overdue that mid-cycle sort of correction. And I think we've moved into this mid-cycle from this early stage recovery cycle. So yes, this could well be the case. And this is the classic sort of stock market cycle where investors start to get concerned about is monetary policy going to change dramatically? There's clearly going to be uncertainty in terms of the Fed actions. And that all leads into the real possibility that we do get a bit of a pullback in equity markets.
What will, I know markets, Roger, are of course at different stages, and some of them are playing catch up depending on where they are in the economic cycle. But is there anything that you want to be fully invested in at the moment?
Yeah, I think in terms of, it's going to be a more volatile market. I think the Fed uncertainty brings this volatility that we've seen before through time and time again. And I think we've got to look through that, because if you're going to try and chase this volatility or position for this volatility, you're going to get whipsawed, I think. So I think ultimately equity markets will stand up in their own 2 feet on 2022. We're going to have reasonable earnings growth. I don't think this is a year where we're going to get more multiple expansion in terms of price earnings ratios. In fact, we could even get a little bit of contraction in that as growth comes through. But I think the earnings outlook is still pretty solid. So we still have a good chance of seeing high single digit, maybe even low double digit earnings growth across global equities this year. And that should be quite supportive for equity market returns.
Christine, two things that you mentioned actually in the morning meeting today. One is a note by Morgan Stanley saying that this is now probably the right time to go bottom fishing, certainly for stock losers. And at the same time, there was an interesting take on why we saw the bond yields move so much.
Absolutely, Francine. And I think that is all part and parcel of the same story, right? This idea that higher yields are particularly harmful to some of these higher growth sectors such as tech. And it would make sense for investors to step back and think about some of the less loved sectors that we've seen over 2021 and potentially consider them as a buy prospect heading into this year. Of course, a lot of these are very much part of the Europe equity story. It's certainly been a value play and something that has been a theme for a few years now. And, you know, we definitely have investors now wondering, is this finally going to be the year that Europe definitely capitalizes on that value story and gets a little bit of ground and momentum against its U.S. peers?
Roger, we have a great chart that we'll bring up in a second looking at some of the technology valuations, and it really shows the divergence between the S&P 500 and some of the other tech stocks, be the ones that make money or the ones that don't. Is there anything that you would be picking up in technology right now?
Yeah, I think you will get good opportunities in technology coming around. And this correction in technology has been going on for quite a while now. And it's been, I suppose, less evident due to the very large technology stocks, which have been very dominant and actually held up the tech sector as a whole. But if we look at that more, as we mentioned, or bond yield sensitive aspect of the technology market, that's been selling off for quite a while now. And some of these stocks will overreact in terms of the sell-off. So I think in terms of the future growth potential of a lot of these names is still pretty solid. And we're going to get to that stage where a lot of these technology, higher growth names actually there's a big overreaction and we get an opportunity to move into these names.
Christine, I know yesterday you were mentioning, yen as something that we really need to keep an eye on. And today, again, we have a great chart looking at fundamentals. Are there currency moves that we should be watching out for that we've overlooked so far?
Well, Francine, I think, it's going to be an interesting interplay, I think, especially for this Haven complex. I mean, we've certainly seen the yen kind of hitting that 5-year low level yesterday and very much consistent with the optimism story. But of course, that is the reverse of today because we're seeing a little bit of risk off here. And and I think it's going to be interesting to watch these havens and which ones prevail heading into this year. Of course, we have the dollar part of the mix as well, but definitely playing into that trajectory is what the Fed is going to be doing. And so, you'd probably want to take a look at other potential hedges heading into this year. The Swiss franc, of course, part of that story as well. That much is still very much a favorite haven because of the fact that the Swiss National Bank is definitely well behind the Fed in terms of tightening prospects. They're definitely not thinking about that at this stage. They're very much still on the intervention path. And so it'd be very interesting to see, which of these havens would end up becoming the favorite hedge heading into 2022, especially as some of these risks from the end of last year come into fruition.
Thank you so much. Christina Aquino there from our FX and rates team. Roger Jones, head of equities at London and Capital, stays with us. Now, coming up, OPEC and its allies have agreed to a 400,000 barrel a day increase in oil output. More on that a little bit later on in the program. Plus, the race to dominate the electric vehicle market is heating up in a challenge to Tesla. We'll bring you more on Elon Musk and our Bloomberg Big Take. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Hong Kong is imposing strict new virus control measures for the first time in almost a year as Omicron seeps into the community. Chief Executive Kailey Leinz says the city will ban dining in after 6 p.m, close venues including bars and gyms, and scrap large-scale events. It's also barring flights from 8 countries including Australia, India, the UK and the US. Now, Boris Johnson says the UK can weather a wave of COVID-19 without tighter restrictions, but warned the National Health Service is under growing strain. A record 218,000 new cases were reported yesterday, driven by the fast-spreading Omicron variant. The UK Prime Minister announced plans for daily testing for some critical workers, but says the vaccine booster programme and current rules are enough for now. OPEC and its allies have agreed to increase oil output. Delegates say the 23-nation alliance, led by Saudi Arabia and Russia, approved a 400,000 barrel a day increase scheduled for February. The group is sticking to its plan to gradually restore output halted during the pandemic after its analysis predicted a smaller than expected surplus this quarter due to weaker supply. Israel's Prime Minister says preliminary data shows that a 4th vaccine dose brings a significant increase in COVID-fighting antibodies. Israel became the first country in the world to offer a 4th shot of the coronavirus vaccine this week, starting with over 60s.
Big news. A week into the 4th dose, we know at a high degree of certainty that the 4th dose is safe. That's the first piece of news. The second piece of news, we know that a week after the administration of the 4th dose, we see a 5-fold increase in the number of antibodies in the vaccinated person.
And the Great Resignation, a record 4.5 million Americans quit their jobs in November, highlighting the persistent churn in the labour market. The increase was broad across industries and pushed the quit rate to 3%, matching the most in data going back to 2000. The unprecedented level of resignations, including a record 1 million in the leisure and hospitality sector alone, suggests a lingering struggle for employees to retain talent. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now let's get back to the markets, and we're back with Roger Jones, head of equities at London and Capital. And Roger, we're talking about the possibility of some kind of catalyst that would mean a correction in equities. Is there anything in what, for example, some of the policymakers, and I'm thinking of the U.S., asking companies to keep prices low to tame inflation, that could backfire? And what does that mean for U.S. equities?
Yeah, absolutely. That's certainly a risk. And I think the risk aspect of that is in certain industries that have cost pressures coming through. So, example, high power users at the moment are going to have an environment where it's going to be tough not to pass through pricing. And I think if we did get into an environment where the market was less certain of companies' abilities to mitigate these cost pressures and put that through pricing, then that could well present an issue. And that would be quite a big headwind for earnings, clearly, as well, as a whole for the market. Now, I think in terms of that happening, I think at the moment it's probably less likely. I think companies will look to push through prices. I think they have the window for that. And I think the market took a lot of comfort from the Q3 results, which showed that companies were willing to do that and that volumes weren't impacted by this pricing increases. But if that were to change, then I think that could well be a trigger event for confidence to be lost in the market and for earnings expectations to start coming down.
So, Roger, if you look at 2022, I mean, we talked a bit about inflation, some of the possible catalysts for a correction. Are we underestimating the political risk, or certainly the role that China will play in all of this?
Yeah, I think that's a fair comment. I think the market has definitely seen that as a very small tail risk and an event that is very unlikely to have a significant impact in developed market equities. Now, that could well come back and bite the market to some extent. I think once you get to this stage where all these risks are piling up and are out there. It doesn't take much when markets are at all-time highs for a correction to be triggered by one of those events actually increasing in terms of its probability of as a risk. However, I think with that, the other side of this is investor sentiment. And investor sentiment is actually still quite low, and positioning is reasonably cautious. Now, whether this was just a year-end sort of phenomenon and we see that reverse in the first quarter, we have to watch that.
Yeah, and from an economics point of view, China has definitely put a bit more accommodation in the economy, which could help certainly at the margins for the rest of the world. What do you do with emerging markets right now, Roger? I mean, on the one hand, they're facing some US dollar headwinds, which I think is one of the points that you highlight. And so they're, very in tune with some kind of Fed moves, but we also have regulation risks.
Yeah, absolutely. And I think we also have pandemic restriction risks as well, a little bit more in emerging markets. Clearly, China has gone from much more closer to zero pandemic policy, which does create quite a lot of domestic economic and international economic implications from doing that, which are headwinds for global growth. But I think overall, in terms of China in the short term, if we did see, I think the forefront of investors' minds is the restrictions that were put in place and in terms of markets. And I think if those were to ease a little bit more alongside, obviously, a more easing monetary environment, then that would help Chinese equities. I think in the medium term, though, investors are going to remain a little bit cautious in terms of Chinese equities and emerging market equities until they see these restrictions and these regulatory interferences stabilizing to some extent.
So what's your biggest conviction, Roger? Is it really the high-quality equities that will win at 2022?
I think that high-quality equities will be well set because with a more volatile equity market and volatility coming back up again, predominantly due to central bank activity, then investors will tend to look through into stocks that have good visibility and can compound good returns. However, I think there is also arguments that are pretty valid from what we discussed earlier in terms of some of the valuation side. I think there's the potential for sectors that have been unloved for a long time and now look inexpensive and in themselves have reasonable quality. For example, some of the telecom stocks, some of the healthcare stocks to have a bit of a revival. And that started a little bit as well.
Roger, thank you so much for joining us. Roger Jones, their head of equities at London and Capital. Now, coming up, surge in energy prices. We discuss how the rise in European energy prices is actually affecting consumers, but also investors, including Uniper, which has been forced to borrow billions to pay down margin calls. That story coming up next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, surging energy prices in recent months have been a concern for consumers and investors. German energy giant Uniper says it was forced to borrow 10 billion euros to pay down margins calls this week as European gas and electricity prices rallied. Let's get more on all of this with Isis Almeida, Bloomberg's European gas, power and renewables editor. Isis, good morning. What exactly is the end game here? What happens to gas prices and what exactly does it mean for Uniper?
Gas prices have been rising quite a bit. We had a bit of a slowdown to that rally at the end of last year when we discovered that there was a flotilla of LNG cargoes coming to Europe. But prices are already on the rise again this year as Russia is now curbing supplies even further with the flows that usually cross Ukraine being even lower. So prices have been on the rise for the past 3 days again. And for companies like Uniper, it really means that great volatility in the market really, it's really difficult for them to cope. And for the companies that have hedged and are trading on the exchange, they do have to post margin costs to guarantee their trades. It's like a collateral.
Yeah, and we're looking at a great chart looking at some of the Gazprom flows to the Northwest Europe, and you can see that, significantly going down almost at a 3-year low. But what's happening with suppliers from the U.S.?
The supplies from the U.S. are still arriving. We have like more than 40 LNG cargoes arriving, and it's just not enough. Like, right? Europe has, I think more than 30. It's almost 40% of the European gas comes from Russia. So it's not easy to replace Russia with anything else. I mean, LNG cargoes can come, but they're never going to be enough to fully replace Russian gas.
Is it too early then, Isis, to talk about CapEx and how that's changing as energy companies try to weather this increasing pressure?
Yes, just to make one thing clear here, like posting money for margin calls, it's like a collateral, right? It's not a loss. It's not money that disappears. So you need to borrow because the amount of money you need to put to keep your trades in place is actually quite high. But it doesn't mean that money is disappearing and that you're going to lose and the companies are going to post big losses. That's not the case at all. It's just that a lot of capital gets tied up with the exchange to back up your trades. So at the moment, we haven't seen anything in big with the energy companies cutting capex, and much like the opposite, I think. A lot of the energy companies, they're spending on renewables.
Isis, thanks so much. Isis Almeida there, Bloomberg Europe gas power and renewables editor. Coming up, staying with the energy story, we'll look at OPEC and its allies having agreed to a 400,000 barrel a day increase in oil output. This is Bloomberg. The Great Rotation, investors flocked to value over growth at the fastest pace since 1995, sending the Nasdaq plunging. Riding out the wave, the UK and France report record virus cases as governments bet they can weather the surge without tighter rules, but Hong Kong adds new restrictions. And OPEC and its allies agree to increase oil output. Demand is expected to withstand Omicron. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. This is what the markets are looking at. They're actually a little bit concerned about what these Fed moves will do. Certainly, we saw a huge sell-off in the Nasdaq and technology stocks. The market now trading sideways. I think the big one, of course, will be the FOMC minutes. Investors hoping to have some kind of clues on the thinking. Remember, this was for December when we heard about tighter monetary policy coming in 2022. The market now pricing in 3 Fed rate hikes, and I think by speaking to a couple of investors, they're hoping to have more of a timing idea of when that first hike comes with the Fed minutes today. Now, OPEC and its allies have agreed to increase oil output. The group is sticking to its plan to gradually restore production halted during the pandemic, approving a 400,000 barrel a day increase. Well, we're joined by Alex Booth. He's head of research at Kpler. Alex, thank you for joining us. If you look at OPEC Plus, we also have to look at compliance. So they say one thing, but then it, depends on how many barrels of oil they actually produce and put out. What's compliance looking at right now?
Well, I think the previous concerns around OPEC compliance is, are they managing to limit their production relative to the expectations in the market? In actual fact, we're in the opposite scenario these days, where they have an agreement to increase this 400,000 barrels a day every month, but actually they've really struggled to do that. So through the second half of last year, we saw exports, or kind of the supply to the market, increase by about 330,000 barrels a day per month on average. So decently lower than the agreement. That did tick up slightly in our data in December, with kind of actually Angola surprising. Oman is slightly higher than we would expect, or the market would expect as well. But the difficulty is that, particularly in, say, West Africa, where Nigeria disappointed last month as well, exports down just over 270,000 barrels a day, month on month. We aren't seeing the oil that OPEC could supply to the market, essentially.
Alex, talk to us a little bit about how tight the market actually looks in the first quarter. I know it's tighter than we thought before because of Omicron, but are we still underestimating it?
Yeah, I think a lot of the balances going into this year were factoring in initially OPEC Plus bringing back that full production allocation as it could. That's not happening. And at the same time, there was a lot of basis on Iran bringing oil back into the market as well. So the fact that there is this drag on supply from OPEC as it is, the talks with Iran are generally progressing quite slowly, so we're not going to see that oil there. And the concerns from Omicron are that's still ever present, but I think waning. And so the demand expectation for most of the world's outside of China, is their caveat, is still quite healthy.
In terms of, some of the surplus supporting that output hike, Alex, were you disappointed with what OPEC Plus did, or do you think they're kind of on track to meet whatever is thrown at them?
I think they've continued to take a very pragmatic approach. We, in the run-up to Christmas, we were saying actually it makes sense for OPEC to maintain the outcome of the decision last month. It made sense for them to maintain supply as they are. It makes sense for them to maintain supply into kind of January and into February. The balances ended the year tight last year. We saw about a 2 million barrel a day deficit in net supply to the market through December. Inventories, as well known, inventories are low on a global basis. They're continuing to decline. And places, for example, where you would have seen historically, or at least through COVID, demand restrictions and kind of mobility restrictions in place, they're opening up. The likes of Australia is having a bit of a change in its strategy against how it combats Omicron compared to previous waves of the virus. The only place where we're kind of really concerned on this demand is the demand impact is with China and Hong Kong, where they are kind of continuing to maintain this very strict control over the virus.
Alex, also in terms of price differential, WTI's discount to Brent seems to remain pretty narrow. Does that change in 2022?
I think we're seeing some kind of real changes in the types of crude that are available in the market. So, for example, there's a statement from Iraq saying they're no longer able to supply Basra Light into the market. That will kind of go into medium grades. We're seeing the changes, which is kind of announced, at least in Mexico. That's a longer term duration. Again, that's going to impact some of those kind of medium sour grades potentially as well. So there are going to be some shifts around in the qualities that we're seeing, and especially as more oil is kind of gradually coming back from OPEC. Kind of at this stage, I'd say it's too soon to say to make a call on that TI Brent differential through the balance of the year. Though we just need to see how these qualities and the volumes of qualities change through the year.
Alex, thanks so much. Alex Booth, their head of research at Kpler, joining us on OPEC. Now, coming up, the race to dominate the electric vehicle market is heating up. We have the Bloomberg Big Take next. We talk Elon Musk. We, of course, talk Tesla and some of the Chinese producers as well. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. China Mobile has surged in its first day of trading in Shanghai. The firm, which is the country's largest wireless carrier by sales, was removed from the U.S. market last year. The state-run company, one of the targets of an investment ban order by former U.S. President Donald Trump, rose as much as 9.4% before paring the advance. Now, China Harong Asset Management is slumping on its return to trade after a 9-month suspension. The bad debt manager says it has taken steps to return to its core business after raising more than $6 billion in a state-led bailout. Harong shares were suspended last April following a delay in its 2020 results. And Morgan Stanley is betting on offices in New York City. Bloomberg's being told the bank has sealed a deal to take over space that houses the headquarters of BlackRock, signing a 15-year lease for roughly 400,000 square feet in Midtown. It is among the biggest property deals signed in New York since the pandemic began. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. So now, back to the markets. Shares of Ford surged to a 20-year high after announcing it's doubling factory capacity to 150,000 for its battery-powered F-150 Lightning pickup. Now, the car maker says electric vehicles could grow to 10% of the U.S. market this year. And Ford president of the Americas and International Market Group, Kumar Galhotra, joined Bloomberg Surveillance to discuss pricing and demand for the vehicle.
Price is one factor, I would say, but I think it's the compelling nature of the product that's really important here. This product has, when we were doing research with our customers, they love the acceleration of it, they love the torque it brings in, they love the payload of 2,000 pounds. It's great driving truck, it's incredibly fast. You know, truck owners love torque, and torque is what this electric vehicle brings. It's more than 770 feet-pound of torque. All of that capability, it's built Ford tough. You know, it's one of the vehicles that's been in a leading high-selling vehicle for us, you know, more than 45 years in a row, leading its segment. So combine all that into a very compelling product proposition with a starting price of under $40,000, $39,974 is what's made this such a compelling proposition for our customers.
Well, no, Kumar, is the issue here selling it to consumers, or is it actually producing enough to sell to consumers? Because that's been the real hang-up when it's come to auto sales over the past 24 months.
Yeah, you know, between the COVID crisis, the chip crisis, the entire industry has struggled to produce that at the levels that we were producing. So you take that crisis, those two twin crises, and then as we're transforming the company to go from internal combustion engines to battery electric vehicles, gauging the demand has been a real trick. We thought we were setting up our factories appropriately for the demand, but as soon as we revealed the vehicle, we had to nearly double the capacity to 80,000. And that's why today's announcement is so important, because even after we increased capacity for this vehicle to 80,000 Lightnings, the reservations continue to come in at record pace. And today, that's why we're announcing that we're going to now increase capacity in this plant to 150,000 Lightnings. And that involves then, you know, all the entire supply chain, the batteries, the motors, the controllers.
So given the fact that you have increased production, that you have seen such robust demand, and that the potential of additional stimulus from the federal government and a broader base of electric vehicle manufacturers, do you think that electric vehicles could reach 10% of the American market by the end of this year?
That's difficult to say, like you said, because it'll be both, not only demand, based on the demand we are seeing for our vehicles, and the rest of the industry is seeing. It feels like the demand is certainly there. But the question will be, how quickly can we, all of us, execute to build capacity to meet that demand? And that's what we are very busy doing. Within the next 24 months, we expect to get to about 600,000 battery electric units globally. And that's before our bigger investments that we're making in Kentucky and Tennessee, both for batteries as well as assembly, come online, because they don't come online until about 2025.
Well, that was the Ford president of the Americas and International Markets Group, Kumar Galhotra, speaking to Bloomberg. Now, are EVs the theme? Well, EVs are the theme of today's Bloomberg Big Take. The race to dominate the electric vehicle industry is definitely heating up. Tesla reported fourth quarter deliveries of more than 308,000 vehicles, handily beating estimates. Legacy car makers Volkswagen and Toyota are also scaling up production as well. And just last month, the companies announced $170 billion worth of investments in EVs. Well, joining us now is Bloomberg's global autos editor. He's Craig Trudell. Now, Craig, good morning. For years, we've heard that car makers countering Tesla with competitive EVs. Should we now take them seriously? Can a Volkswagen actually overtake Tesla in producing electric vehicles?
I think Volkswagen is sort of a cautionary tale that this is not just going to be a matter of sort of flipping a switch. I think, you know, as your question alludes to, I think this has been something that a lot of, you know, investors in traditional car companies have just sort of thought is a foregone conclusion that, you know, Tesla is going to essentially awake the sleeping giants, if you will. It's not going to be easy, but we're certainly seeing a much more significant scaling up on the part of big companies like Volkswagen and Toyota. I think the latter of those companies really didn't necessarily need to go fully electric. They didn't need to from a compliance perspective. They made the correct bet, you know, years ago to go hybrid when Volkswagen was going with diesel, and they did not have an emissions scandal that really dented their reputation. So I think it's a case where, you know, Toyota did, however, face quite a bit of criticism over the last year or two for sort of being perceived as dragging their feet. They're really pushing into that now. I think the extent to which investors have really embraced electric vehicles also is putting more pressure on these companies.
But Craig,
yes,
how will they succeed? I mean, I know, and this is a beautifully written article, and I urge everyone to really check it out on our website and also on the Bloomberg terminal. But I don't know whether it's a software. We were talking off air about the fact that Teslas, for example, do light shows, and I think we also have pictures where it's just the cool factor, right? Kids recognize a Tesla, they identify maybe with Elon Musk, and so how does a Toyota or a Volkswagen counter that?
Yeah, I think it's going to be the case that we're not necessarily going to see a Toyota or a VW or a Ford sort of try to play Tesla's game in terms of going on social media and acting the way Elon Musk does. But we're definitely going to see a big push for the over-the-air software capabilities that enabled cool factors and features like we've seen out of Tesla. I think Volkswagen was a little bit slow out of the gate with their ID series, bringing that capability. But we've seen Herbert Diess talk about testing out the over-the-air update that ID customers are going to be getting over the coming months. We're seeing a lot of companies, finally coming around to enabling this technology. I think it's something that is overlooked in terms of a big competitive advantage that Tesla has been able to preserve, despite the fact that this is something that they've been doing for years now. It's been difficult for the industry to sort of move away from sort of dependence on suppliers and really bring in-house the expertise that they need to have. The vertical integration that Tesla brings to bear in this regard has really been a competitive advantage up to this point.
I mean, I don't know whether the comparison between Tesla and Apple and what they did to a lot of the competitors is actually fair or not at this point, but are we underestimating some of the Chinese EV producers and how much market share they could have globally?
I think that's a very very good question. I think with Volkswagen, you've seen whether it's Herbert Diess, the CEO there, or even Elon Musk recently have talked about the idea that Chinese electric vehicle companies really bring a lot of skill and bring some of that same sort of software innovation to bear. We've seen significant uptake in their sales. We've seen them jump out to sales levels that it took much longer for Tesla to get to when they were initially ramping up. So they're certainly ones to watch. To this point, they've really been largely limited to China, but I think it's only a matter of time before we start to see them, really look abroad to expand here in Europe as well.
Craig, thank you so much for the roundup. I mean, it's amazing. I think we did a very quick survey in the newsroom, and it seems like every child, like 4 years and above, can recognize a Tesla in London. And Bloomberg's global auto editor, Craig Trudell. And you can read the full article on Bloomberg.com and also on the terminal. Just type NI Big Take. Coming up, Bitcoin will continue eating into gold's market share. At least that's according to Goldman Sachs. We'll have more on that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Goldman Sachs says Bitcoin is likely to take market share from gold. It sees a cryptocurrency's market cap at just under $700 billion. Now, that's about 20% of the market for what it describes as store of value assets. Our Bloomberg Markets Live deputy managing editor, and also my favorite person to talk canines with because he's a newly minted dad dog, is our managing editor, Eddie van der Waals. He joins us now on cryptocurrencies. Eddie, always great to have insight from you on what cryptocurrencies is doing and how we should be thinking about it. Is Bitcoin actually getting market share from gold at this point?
We should really be talking about Dogecoin, you and me. That will kind of bridge the two divides. But listen, my one problem with this story is that is the idea that there is a fixed haven or store of value market which gold and Bitcoin will split between them. I actually think that Bitcoin has made the store of value market and the mistrust in the dollar market bigger. More people now are talking about fiat currencies than ever before. It's something that's entered the mainstream as a result of Bitcoin. And Bitcoin investors who make a lot of money, I've spoken to gold dealers who tell me, look, we've seen crypto millionaires walk through our door saying, listen, we want to diversify, we'll diversify into gold. So I actually think there's a symbiotic relationship between these two asset classes.
Eddie, and the other thing is that everyone's talking about $100,000. Why? I mean, is it a psychological level, or does it actually mean something?
Well, you know, it's double from where we are, and it sounds like really out there. Why would somebody pay $100,000 for these, you know, digital assets that don't even exist in the real world? But we would have said the same thing about 50,000 and about 2,000 before that, right? I still have friends who are mad at me because I told them in 2012 or so that cryptos are going to go to zero, and then didn't buy, and now look where we are. So no, you know, you can't write off a number like 100,000. But I wouldn't necessarily stop there either. If cryptocurrencies see widespread adoption, you know, the sky's the limit, really. But don't forget about the downside. These are very volatile investment classes.
Yeah, remind me not to take any investment advice over cocktails, chatting about canines. We're just getting some breaking news, actually, here in the UK, and it feels like significant. It's not moving markets, but actually the UK Labour leader, so the opposition to the Prime Minister Boris Johnson, Keir Starmer, has tested positive for coronavirus. That's according to PA. Again, we understand that it is a milder infection, given the trials that we had over the last couple of days, but again, something that we need to keep an eye on if things get worse. Mr. Starmer just testing positive for coronavirus. Eddie, back to some of the Bitcoins and some of the cryptocurrencies that we were talking about. Could Bitcoin actually be overtaken by another cryptocurrency this year?
You know, I think this is really going to be the conversation for this year. Last year was all about how it was a breakthrough year for cryptocurrencies. We saw IPOs in some of the exchanges. We saw ETFs launch in the US and the futures market really coming into its own. So institutional investment in the institutional adoption for Bitcoin really happened last year. But don't forget, none of that's happened in Ethereum yet, right? We don't really have the big Ethereum ETFs. We don't have the Ethereum futures contracts. And, you know, I think all of that now comes to the rest of the cryptocurrency space. They'll be slower to adopt, but the upside there will be even bigger. The problem is that the volatility there is also, again, greater. The beta on an Ethereum or on a Dogecoin is significantly higher than it is on Bitcoin.
All right. Eddie, you and me, we're going to talk about Doge and canines in the next couple of days. Thank you. That was Bloomberg MLive editor Eddie van der Walt. Now, Bloomberg Surveillance Early Edition continues in the next hour. Kailey Leinz will be in New York. Here in London, Danny Berger and Anna Edwards take the reins. European stocks are rising at the moment. Futures in the U.S. also trimming some of the losses. Investors weighing the outlook for global inflation against expanded COVID-related curbs. This is Bloomberg.
Once the COVID shock passes and things start to go back to normal and workers fully return and demand goes back to normal, I don't see any reason why the economy wouldn't revert back to the low inflation regime that we've been in for 20 years.
I think that over the next 2 to 3 weeks, we will see a drop off on this. So everything is under control. It's not as crazy as you would think.
Together with the Plan B measures that we introduced before Christmas, we have a chance to ride out this Omicron wave without shutting down our country.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Wednesday, January 5th. Our top stories today. Shutting down. Hong Kong bans flights from 8 countries and closes bars and gyms to contain Omicron. European stocks are rising and U.S. futures are trimming losses after a tech sell-off batters Wall Street and Asia. And no negotiation. Senator Manchin says talks have not restarted on Biden's economic agenda. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger today in London and Kailey Leinz in New York. Matt Miller is off today. And Kailey, tech sell-off was certainly a big theme on Wall Street, a big theme in Asia, not finding much expression here in Europe, but it could do once again if you look at US futures.
Yeah, it is once again NASDAQ 100 futures that are underperforming here in the U.S. with about 4.5 hours to go until the opening bell, Anna. And you definitely, as you alluded to, saw that tech sell-off taking place in Asia. Broadly, Asian stocks were lower. It was a down day for the MSCI Asia Pacific Index, but it was the Hang Seng Tech Index that really was the big drag. That index falling 4.6% on the day. You had the likes of Tencent and some of its other holding companies, the likes of Meituan, others that it is invested in, actually some of the big underperformers as Tencent starts pulling back its stakes in different companies, maybe trying to ease some of that regulatory pressure. But of course, the other story with big tech is the fact that yields are moving higher, and we definitely saw that overnight in places like New Zealand, where the 10-year yield was up about 8 basis points. And finally, in FX, I did want to point to the Japanese yen because, of course, it hit its weakest level against the dollar since early 2017 yesterday. It is starting to gain some of that strength back. We are back through a 116 handle right now at 115.85. Now, here in the U.S., as I said, it is tech that is once again lagging in the future session. NASDAQ 100 futures down a few tenths of 1%. Of course, that's as we see yields moving lower today. They have been moving up, though, dramatically over the last 2 days. So still, even though we're down about a basis point today, we're sitting at 164 on the 10-year Treasury. I would also point to crude, which is essentially flat. The market's still trying to digest that OPEC hike coming in February. Another 400,000 barrels a day coming onto the market. What exactly does that mean? So we're still looking at a 76 handle on WTI. And interesting, Danny, even though Bitcoin usually is correlated to risk appetite, and risk appetite doesn't really seem to be there to a large extent today, Bitcoin is still in positive territory on the day, trading just below $47,000, Danny.
And we even heard from Goldman saying that they expect Bitcoin might go to $100,000. They're using the price of gold, saying that if it's used for digital store of value, so that could be driving that as well. Kailey, it's a more bright picture in European equities than it is in the U.S. Europe really has the benefit of when you get that cyclical value type rotation, these are the types of equities that do well because there's less big tech in Europe. There's more industrials. There's more autos. So autos, energy, the best performing sector so far today. That means the DAX is outperforming. A lot of autos and industrials are indeed in this index. That's up 0.6%. A little bit weaker when it comes to the UK, 0.3%, 0.5% for the CAC 40. But altogether, this means the Stock 600 is yet again trading at another record. This would be the second day in a row of record setting for the European main index. We are seeing a stronger euro today, up about 0.2%, mainly due to dollar weakness. We are seeing the dollar weaker against most of its G10 peers. German bonds, 10-year yields moving up by 3 basis points. We are the closest to 0% nearly since May 2019. Not only does this reflect the move we saw to sell U.S. Treasuries yesterday, but at the same time, we have more supply coming online today. So some heavy selling ahead of that. And finally, Anna, I had to bring up Dutch gas, natural gas equity futures, rather, that is up 6.5%, the third consecutive day of gains for this asset. Still, no Russian supply. We continue to get whiplash from natural gas.
Absolutely. Another day we watch gas prices go higher here in Europe. The UK contract also moving to the upside. Danny, thanks for the rundown there. Let's get to the day ahead then. A quick briefing on the things that are in focus. And of course, Fed minutes will be centre stage. We'll get those minutes from the December meeting at 2 p.m. New York time. They will cover its decision to move more quickly to wind down bond buying. What new information can we get from these minutes? We'll get into that conversation a little bit later on. Now, Germany's new foreign minister, Annalena Baerbock, is heading to D.C. She'll be talking to Antony Blinken on the Ukraine-Russia situation. We'll talk later about that, tie that in with the gas story Danny and I were just referencing. And we'll get some U.S. data later on today as well, including mortgage applications and ADP employment changes. How good or not an indicator is the ADP number of what's going on in the U.S. jobs market more broadly? We'll get an update on our thinking there later on. Now, let's get back to our top story around COVID restrictions, and certainly our focus there is on Hong Kong. Hong Kong is imposing new virus measures for the first time in almost a year. The tightening comes as the city seeks to contain the Omicron variant. Carrie Lam, Hong Kong chief executive, spoke about this at a briefing today.
My view is that given the very dire situation of the pandemic, we have to grasp this very critical moment. We have to contain the pandemic to ensure that there will not be a major outbreak in the community again.
Let's get more with Sam Fazeli, Senior Pharmaceuticals Analyst for Bloomberg Intelligence. And I suppose it's a political question, really, isn't it? To what extent or for how long can Hong Kong and China continue to manage this in a very different way from the way we see much of the rest of the world managing this, Sam? Is that something that concerns you, the policy divergence between what we're seeing in Greater China and what we see in the rest of the world?
Anna, hi. I think this is indeed exactly what we're going to have to worry about going forward. You have the UK on the one hand pretty much open in terms of what it's doing and how people can go about their normal life. And then you've got some countries which are still insistent on keeping Omicron or COVID into with something that smells like or sounds like, feels like a zero COVID policy. And honestly, I'm finding it increasingly difficult to understand how they're going to get themselves out of this, given that it's not just humans that transmit the virus. This virus has become very good at infecting other animals, which are cohabiting with us. So I really don't see how they're going to be able to get through this with these current policies.
Sam, you mentioned the UK. Just moments ago, we learned that the government is weighing lifting pre-departure COVID tests for those arriving in the country. Is the UK and really most of the West that isn't pursuing this zero COVID policy, are they in a position that they can start to ease restrictions?
Danny, I hope that's the case, because we've got, at some point, having done everything we've done, I've had 3 doses. I'm pretty sure you've had 3 doses. After everything we've done with the antivirals that we have and the drugs that we have and what we've learned, we can't keep keeping a lid on people's activities and getting on with their life. And how that shapes up, I'm still thinking about it a little bit, but 2022 has to be the year that we find really, truly a way to live with this virus without creating streets that are empty all the time.
Yeah, I think I speak for most people when I say we all certainly want to get on with our lives. Sam, thank you so much, as always. That's Sam Fazeli, Senior Pharmaceutical Analyst for Bloomberg Intelligence. Now over to D.C., where Senator Joe Manchin said Tuesday he's not in talks with the White House or top Democrats on reviving President Biden's $2 trillion tax and social spending agenda. That leaves the administration's signature domestic initiative stalled. Anne-Marie Horder, Bloomberg Washington correspondent, joins us now from D.C. So Anne-Marie, the Joe Manchin back and forth continues. What would it take for negotiations to start up again?
Yeah, at the moment, he says there are no negotiations going on. No, we should note Senator Schumer did say over the holiday break he did speak to Senator Joe Manchin from West Virginia on a number of issues, including voting rights and the economic agenda. There's one moment yesterday when he was talking to reporters that it did seem that he could be open to one policy framework, and that would be on climate change. Potentially there would have to be negotiations, though, around EV tax credits, a little bit of thinking in the Democratic Party on that. But he did keep that open. A lot of other policies within the Build Back Better agenda, though, he still remains concerned, especially regarding child tax credits. But I have to say, they are really starting January with putting Build Back Better on ice. And when you talk to the Democratic leadership and members of the party on the Hill, they are shifting the focus, especially ahead of January 6th tomorrow, on voting legislation. So expect to hear a lot about that. And really, that's by design. Senator Chuck Schumer says he wants movement on that before January 17th.
Well, Anne-Marie, I'm glad you mentioned January 6th, because obviously it's going to be the one-year anniversary of the insurrection at the Capitol tomorrow. I understand that former President Trump will no longer be holding a press conference tomorrow. What are we expecting to happen in Washington?
Yeah, President Trump last night has said that he is going to bench his press conference and he'll talk about what he planned to talk about, likely his claims, which are many say are not correct. And he'll talk about that at a future rally later in January in Arizona. What we can expect out of Washington is going to be the president, the vice president. They're going to be making a speech talking about that riot 1 year ago, marking it at the Capitol. And there's going to be really a slate of events from the Democratic Party. The individuals that are not going to want to share some of the spotlight are going to be the Republicans. The former president really has made this a political litmus test for them. Many Republicans who were at the Capitol 1 year ago, nearly to the day, they were under siege. They came out criticizing former President Trump after that. But now this year, it is very difficult for them to do the same. So you're going to see them really shy away from talking about this tomorrow.
Anne-Marie, thank you very much. Bloomberg's Anne-Marie Hordern with the latest on Joe Manchin and indeed as we look ahead to tomorrow, to January 6th. Now, tech is coming under pressure globally as concerns grow over rising rates. The US yield curve has seen its most dramatic steepening in more than 3 months. Bloomberg's Tom McKenzie joins us now. Tom, good morning once again. Let me ask you about what we're seeing on the tech sell-off, because it's not finding much expression here in Europe. We don't have such a prominent tech sector, I suppose, but it certainly was dominant on Wall Street yesterday and then through into the Asia session, but it had a slightly different driver through Asia.
Yeah, that's right. So obviously the worst start, as we've been noting, for the growth story since 1995, so a significant rotation. Danny mentioned, of course, the different picture here in Europe, and whether or not that's going to be sustained. We saw this twice in 2021, so is it going to be a head fake? But of course it is tied to what's happening in the yield curve. I got onto that shortly because you did touch on what's happening in Asia. That is very interesting. Tencent selling down part of its stake in Sea, which is an e-commerce and gaming giant in Southeast Asia. Why is this important? Because if you get Tencent divesting its $185 billion portfolio from the tech space in Asia, that has huge implications. Then there's the yield curve. You are getting that steepening. Now, you do have the MLive team suggesting that this is bear steepening you're seeing, because the twos are about 1 basis point away from where they are in December 28th when there was a gap higher. They haven't moved significantly. It's the back end. It's the 10s and the 30s, up about 15 basis points. That suggests there's some technical factors at play, and that is where you look at corporate issuance getting in there before we get higher rates amid these expectations of possibly 3 hikes this year.
So, Tom, if it's more technical factors that are playing into the yield space right now versus just a repricing of Fed expectations, could that change considering we get Fed minutes at 2 p.m. Eastern time and we'll get more insight into what exactly they were thinking at that December meeting?
I mean, absolutely, that is the focus for markets today. The FOMC coming out, and of course, you even have Neil Kashkari, not a voting member, but even he is looking at 2 rate hikes this year. A key dove, of course, within the monetary policy community, even if he's not a voting member. So we're looking at the FOMC minutes, but of course, it's also about the technical factors, the corporate issuance, but also just the way markets are thinking about the Omicron impact on inflation. And there seems to be a consensus now that it's going to impact supply chains. That's going to drive up inflation. And the markets seem to be pricing in possibly softer growth. Maybe that gets the Fed to wait slightly, possibly past the March. Maybe you get to May. That seems to be the consensus. And then longer term, they're going to have to pay catch up on hikes. And that's why you're seeing steepening at the 10s and 30s. But of course, that could all change as we watch the Omicron data. And of course, the issuance starts to reduce towards the end of January. You could, in fact, see yields start to come down again from our MLive team.
Yeah, the technicals versus the fundamentals. Tom, thank you very much. As always, that's Bloomberg's Tom McKenzie. Now a look at what's moving in the pre-market trading session in the U.S. And I want to start with a stock that follows very nicely off of what Tom was mentioning about tech stocks in China being hit because of Tencent divestment on one company, Bilibili, that's an entertainment company, down 4%. This is its U.S. ADR. We're also looking at Salesforce declining in the pre-market session. Not only is it tech, but it's also a downgrade from UBS, concern over sales there. And finally, Beyond Meat, this one's moving higher in the pre-market. Anna, apparently KFC is going to start selling Beyond Meat chicken.
Well, that is something to watch. I also like the title of one of our colleagues' pieces, though, that says food fights are not the way to cure CO2 crisis in farming, something that will rumble on, no doubt. We'll return to those ESG themes around food. Now, coming up on this programme, we'll get the perspective on a lot of the conversations we've already set up this morning. Freya Beamish will join us. T.S. Lombard, Head of Macro Research. What does she think is steepening the US yield curve? How will that play out for equities? How will China navigate the Omicron wave? Plus, we'll get a perspective on OPEC. OPEC Plus agreeing to revive more output, what that means for a tightening market. We'll get into that conversation ahead. Plus, the pledge to dethrone Tesla. More on the epic fight over the future of autos. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. Now, markets seem like they've finally woken up from their post-holiday slumber, and they've woken up to a great rotation. Yesterday was notable for growth, those momentum-y type names selling off to the benefit of value. So I want to dive into the terminal. I also want to welcome our radio listening audience. I have a chart in front of me that I will explain to you so you can understand it. Basically, I have a few different indices here, but I really want to demonstrate what took the leg lower yesterday. At the top in the white line, you have the S&P 500, which stays little changed. However, what dives yesterday? You have a Goldman index of profitless tech, you have expensive software, and you have the Renaissance IPO indices. Basically, these are very expensive equities. They do well when rates are low. So does a higher rate regime mean that we can see more days of a rotation like this? Let's bring this question to Christine Aquino, our markets editor. So, Christine, how much staying power does this rotation look like it has?
Well, Danny, I think it's going to depend now on the path for yields and Treasury yields in particular, because I think that's going to be what everyone is watching out for. And investors are already starting to brace for the potential pain point, particularly on a 10-year level. We're seeing in markets at the moment bets for the Treasury 10-year yield to hit 1.95% by February. And the big question is, how fast is it going to get there, and how much pain is it going to inflict on the way higher to those levels?
Yeah, Christine, I mean, one big question for me then is, what does the NASDAQ do? Because to Danny's point, there have been lots of signs that parts of the tech universe are already selling off, have been for weeks, in fact, but that is not the overall tech story necessarily. And so, as if it needs saying, you're going to have to get into the details, into the weeds around different types of tech names. So where does that leave the overall sort of tech narrative?
Absolutely, Anna. That is the big question, right? And I think what we're going to see here is really a lot more differentiation between some of the, shall we say, lower quality tech stocks that Danny was talking about, some of those profitless companies that do better when things are going great, but not so much when they're in this sort of higher yield environment. And then a differentiation from that part of the tech sector versus, you know, some of your more traditional big tech names, Apple, for instance, and Tesla, some of those bigger names that seem to be still enjoying this relatively positive sentiment for the sector. But I think it's going to be a lot more discerning for investors now moving forward.
Yeah, it's interesting. Some of those big tech names obviously have somewhat of a defensive quality about them, it seems. But when we talk about how yields fit into this and potential catalysts for the bond market, what do you think the market is going to be most focused on looking for in the Fed minutes today? Is it more color on rate liftoff, or is it really, you know, the possibility of a balance sheet runoff in that conversation?
Kailey, I think it's going to be a mix of both, because I think, you know, we're in this environment now where the prospect of Fed rate hikes is something that markets are starting to accept. We're finally seeing rates markets agreeing with Fed officials, Jay Powell's indication for 3 rate hikes this year. We've seen markets starting to price that now. But then, of course, it's a question of how quickly this balance sheet runoff is going to come, because if you get into a situation where rates are tightening simultaneously as we're seeing that balance sheet runoff, and more importantly, faster and sooner than markets are expecting, then that tends to have less of a positive effect, especially for risk assets that have really enjoyed this low yield, accommodative policy environment for so long.
Yeah, it does seem as if, Christine, there's been so much moving on since the Fed minutes, since the Fed meeting rather, but the minutes could still tell us something new about the way the market and the Fed is approaching this. Christine, thank you very much. Christine Aquino from our Markets Live team, Markets editor, in fact. And for more market analysis, check out MLIV Go. That is the function to use on your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger alongside Anna Edwards in London and Kailey Leinz in New York. Matt Miller is off today. Now let's get to the first word news. And the U.S. CDC has reclassified its travel advisory for Singapore, telling Americans to avoid traveling to the city because its COVID levels are unknown. Singapore now joins the same classification category as Afghanistan, North Korea, and Syria. The city-state's weekly infection rate has increased at its fastest pace in nearly 2 months, with over 800 cases reported Tuesday. A record 4.5 million Americans quit their jobs in November, highlighting persistent churn in the labor market. The increase was broad across industries and pushed the quits rate up to 3%. That matches the data going back to 2000 for the highest level. The unprecedented level of resignations, including a record 1 million in leisure and hospitality alone, suggests a lingering struggle for employers to retain talent. And Goldman Sachs says Bitcoin at $100,000 is a possibility as it continues to take the market share from gold as part of a broader adoption of digital assets. The U.S. Bank estimates that Bitcoin's float-adjusted market cap accounts for a fifth of the global store of market value. If the digital currency share rose 50% over the next 5 years, that would be the gain to 100,000. Coming up, Freya Beamish, TS Lombard Head of Macro Research. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger in London and Kailey Leinz in New York. Matt Miller is off today. And Kailey, one of the big data points of the week or things we're going to be watching out for, releases of the week, is the Fed minutes, of course. And that's going to be a focus for investors, even though it seems that so much has happened since we got that pivot to the real focus on inflation. In some senses, the market led that. The market kind of saw that coming, knew the Fed was going to pivot in that direction, it seemed, when we got there. So you do have to wonder how much new there will be in these Fed minutes, how backward looking they'll be. But there is this conversation around balance sheet runoff, and that could be a focus.
Yeah, obviously we know what the Fed decided at the December meeting. It dropped the word transitory. That dot plot moved up to 3 hikes for the Fed this year. And we also know that they doubled the pace of the taper. The question is, what conversation were they having around that tapering, which is now going to end in March, and what that means for sequencing, when rate liftoff was going to happen, what criteria they are looking for in that regard. And then, of course, as you say, Anna, that balance sheet. Everyone has been so focused on when we start to see rate hikes. Obviously, QE is going to wind down by March. What happens then? When do we start having the conversation about QT? I think that any clues around that are something that the market is going to be very closely paying attention to.
So those are the clues we'll look for in the Fed minutes. Danny, what are you watching ahead of the US market open? Of course, investors are going to be waiting for these Fed minutes, just as they do every month. But we do have tech stocks as a theme and NASDAQ futures on the move.
It certainly is. And look, any reaction and yields to those Fed minutes are going to be crucial for the entirety of the market, just because we have seen these higher yields, their ability to punish those highly valued equities. At the moment, it is steady as she goes in terms of yields. The only place we're getting some movement is on the long end of the curve. Here we are seeing the opposite of yesterday. We are seeing some buying coming into force just by about 2 basis points. We're still looking at 30-year yields over 2%. We're also looking at a weaker dollar today, translating into a stronger euro dollar. That's at 113.13. And Anna, as you mentioned, it's about tech. It's about this rotation. Just in the past few minutes, we saw the S&P 500 E-mini futures move into positive territory ever so slightly, but still NASDAQ 100 futures down about 0.1%. So this rotation might still be going on. Let's dive into some of the individual names in the pre-market, looking at these type of rotationary names. Tesla and AMD. Here you have the expensive stocks, the tech stocks. Those, again, were hurt in yesterday's session, the biggest rotation since 1995. Continue to do poorly in the pre-market session, down 0.8% and 0.5% respectively for Tesla and AMD. Bank of America and the big industrial names, the energy names, Occidental, both of those did well yesterday. Bank of America up again pre-market 0.3%. Occidental, after its 7% rally, is taking a bit of a breather this morning, 0.5%. So as I say, this rotation largely driven by yields. But what's driving the yields in turn? For our radio listening audience, I've just put a chart up in front of me of the 2s10s yield curve, a very simple chart of just that. Now, in the past few days, the past 2 days, I should be exact, we've seen a pretty significant steepening. In fact, the biggest steepening in quite a few months, in 3 months, I should say. Now, this was led by 10s. So how much of this is a reaction to the Fed? How much of it is technical about new corporate supply coming online and lack of liquidity? Well, joining us now to discuss is Freya Beamish, Head of Macro Research at TS Lombard. Freya, thanks so much for joining us this morning. So can we attribute this move in yields to positioning around the Fed, or is it more technical?
Yeah, I think that there could be some Fed positioning there. That we're of the opinion that the inflation anxiety hasn't really peaked yet, and specifically that that little mention of the relearning about the balance sheet that was dropped in at the press conference in December, that seems to have come more to the fore with the talk of the balance sheet runoff. And it's a very difficult environment for central banks to navigate, because you've got this big change on both the supply and the demand side. Now, central banking 101 is that you don't respond to a negative supply shock, and in fact it can be counterproductive to respond to a negative supply shock. But at the same time, we've got the legacy of this of the stimulus through the pandemic that is impacting on demand as well. So inflation anxiety probably hasn't peaked yet, but I think as we go through the year, we could end up in a very different environment, and I would have some very strong kind of pushbacks against the kind of outright inflationistas. The main one being that the Fed doesn't want to, and probably won't need to in the environment that we're forecasting. They don't want to derail the rebalancing, the necessary rebalancing that is taking place in the economy. And in fact, there's two forms of rebalancing that are happening. Okay. One is the kind of the change in the shape of the economy to accommodate the presence of an endemic virus, and the second is the change in wages with respect to the rest of the economy and to wealth in the economy. And we can see that very clearly in the quits rate as well. So this was part of the AIT promise of the Fed. And we think probably with the goods price deflation that we're forecasting in the second half of the year, the Fed won't need to break that promise of AIT and won't need to go quite as fast as the inflationistas are predicting.
Okay, so if it doesn't have to go quite so fast, Freya, as some voices are predicting, how soon do we get the first hike? You've talked in your notes about how expectations around a March hike could still build from here. Maybe that's something that moves the yield curves as well. How likely is that, though?
Yeah, the March hike, we started forecasting that kind of towards the end of last year, and it did come on very quickly. There was a big shift in market pricing over the course of Q4, and markets have now moved in our direction with regards to the pricing of that first hike. And I think, as I said, inflation anxiety has not yet peaked, and the likelihood is that the Fed is ready to begin normalizing, and will therefore kick off in March rather than any later in the year. But then going through the rest of the year, kind of 2 to 3 hikes will probably be sufficient to kind of achieve what the Fed is wanting to achieve, without derailing those rebalancing forces that I was talking about, the relative price shifts that show up in high inflation. But that doesn't necessarily last for longer, that they actually kind of want to get this wage growth coming through and helping to rebalance the economy. Now, that will be facilitated, coming good on that promise, will be facilitated by goods price deflation and the woes that we see in China, which will probably result in renminbi depreciation, amplifying that kind of global goods deflation that we see in the second half of the year.
Well, Freya, I'm glad you brought up China, because obviously it has been firm in its COVID zero policy that's resulted in the shutdown of entire cities of millions of people. And at the same time, you're seeing more restrictions put into place in places like Hong Kong. We just had a headline crossing the Bloomberg terminal from a Japanese newspaper that Tokyo is now seeking government approval for more COVID-related restrictions. As you think about the Omicron variant, do you think it poses a greater growth risk, considering what we're seeing in Asia, or an inflation risk?
I think certainly the high frequency figures that we're seeing coming through actually kind of across the globe suggest that there will be an impact, kind of a negative impact on activity. Looking at Google Trends and kind of the relevant counterparts in China. In the first quarter, but there should be a recovery there. And of course, in China, it's going to be slightly different because they still do have the zero COVID tolerance policy in place. And that really is not just a kind of a Communist Party control freak thing. It's also It's also the simple fact that they don't have enough hospital beds to be able to take the kinds of gambles that Boris Johnson is taking and that are being taken in the US. So it's a deep-seated problem that they have in China. Now, kind of looking further ahead, Omicron could present a sort of ray of hope at the end of the tunnel if it does crowd out more serious variants. But where we are at the moment is that there's still a lot of uncertainty. For instance, in London, cases in the older age population are still rising, despite the fact that it's peaking out for the overall population. And that could place a lot of pressure on kind of general and acute bed pressures rather than ICU. So there's still a lot of uncertainty. There's still a lot of staff absences that are being caused by it. And for the moment, it does look like it's a restraint on both supply and demand in the first quarter of this year, kind of globally.
Sticking with China, Freya, I mean, we've certainly seen them build hospitals pretty quickly. They did that in the early stages of the pandemic, didn't they? So we'll watch that with interest. I mean, maybe that'll give us a clue to policy. But we are seeing a big disconnect between what Hong Kong and China are doing right now and what many other parts of the world are doing in the willingness to live with COVID to some extent. Does something break that, Freya? Tapping into your experience of tracking the Chinese economy, the Chinese political drama, does anything break that zero tolerance?
So we're starting to see growth and policy really reacting to the slowdown that we've seen in growth over the course of the second half of last year. So already in Q3, there was almost zero growth quarter on quarter real GDP. And in Q4, you should kind of get some rebound to that just because of the slightly better COVID situation in the first part, and also kind of a few other idiosyncratic factors. But broadly speaking, growth is extremely weak in China. And only just starting to see some kind of stabilization at these weak levels in the high frequency figures that one of my colleagues has put together on kind of Baidu trends and the different kind of confidence indicators that we can derive from the stock market as well. So we're starting to see a little bit of stabilization there, but policymakers certainly seem to be taking this very seriously. We've had an outright reduction in the LPR at the end of last year. Okay, it was very small, but amid the kind of much more hawkish drift that we're seeing in the rest of the world, it certainly stands out. We've had further lending facilities, environmental lending facilities introduced on a significant scale as well. So it's certainly the case that they are taking the slowdown very seriously. We haven't seen them going to the so-called flooding easing yet, and we don't think that they will. But the reality of the situation is that the policy put is much less effective than it has been previously. We're already seeing that showing up in the lack of response of kind of credit there. A lack of response to meeting the credit quota. And that suggests that at some stage there will be further pressure on policymakers to break with the zero COVID tolerance policy, but they do have this kind of backdrop of a problem of lack of hospital beds at the moment. So maybe Omicron is helpful to them if it's less serious than the previous waves, and that could start to change things as well. But for the moment, they seem very well to zero COVID tolerance.
Freya, thank you very much. Thanks for joining us. Freya Beamish, Head of Macro Research at TS Lombard. Coming up, OPEC Plus and its allies agree to revive more output. We will get the latest reaction to what we heard from OPEC Plus this week. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Cristiano Amon, Qualcomm President and CEO. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger in London and Kailey Leinz in New York. Matt Miller is off today. Now let's get to the oil story because OPEC and its allies agreed to revive more output as the outlook for global oil markets improved, according to OPEC's own assessments. At a meeting this week, the alliance approved the 400,000 barrel a day increase scheduled for February. So far, so much expected. Paul Wallace, who leads our energy and commodities coverage in the Middle East and North Africa, but is in London this week, joins us with his thoughts. So the aftermath of the OPEC Plus meeting then, what did we learn here, Paul? We expected they'd go through with this 400,000. I suppose it's a suggestion of their confidence in the demand story that they did do that.
Hi, Anna. Yes, yesterday's meeting was a very smooth one, and that's what traders had expected. And on the one hand, yes, you can say that this is a sign that OPEC Plus sees demand staying strong and perhaps even rising over the next few months, and that it doesn't see Omicron affecting mobility and consumption of fuel products too much over that period. One interesting thing to watch out for later today, however, will be Saudi Aramco's official selling prices that they will set for February today. If they raise prices, that will be a sure sign that Saudi Arabia, at least, is very bullish about oil prices. There is a chance, though, that they lower them slightly, and I think that will tell you that at least Saudi Arabia is, while it may be confident about demand staying strong, it doesn't think the market necessarily has much further to run up from here.
Okay, so demand they think is staying strong, but on the supply side, while they are technically allowed to raise production by as much as 400,000 barrels a day in February, can they actually produce that much? I mean, what would the actual number look like?
That's a very big question for OPEC Plus watchers at the moment. And as you said, there are problems with production in many countries like Angola and Nigeria. And then you have others such as Russia, which are pretty much at full capacity at the moment. Depending on which analysts you speak to, they seem to think that OPEC Plus can do a maximum of about 250,000 barrels a day of extra production a month. Some think it's even lower than that. Some think that maybe OPEC Plus will only do about an extra 150,000 barrels a day this month. So it is, most analysts are saying that OPEC Plus can probably do, give or take, only half of what it's actually saying it will.
Paul, thanks very much. Paul Wallace, who leads our energy and commodities coverage in the Middle East and North Africa, taking us through what we learned this week from OPEC Plus. Coming up, the fight over the future of electric vehicles. More on how the big volume manufacturers are they really this time fighting back against Tesla? We get today's big take next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger alongside Anna Edwards in London and Kailey Leinz in New York. Matt Miller is off today. Now let's get a look at what we're watching today. And I have my eyes squarely focused on travel restrictions in the UK. The UK government weighing dropping its COVID test mandate for those entering the region. Boris Johnson has been clear he's keeping things steady as they go, but this is a turn in terms of lifting restrictions. Also comes at a time where the opposition party leader Keir Starmer has tested positive for COVID. But Kailey, could be good news for you when you decide to come visit us over here in London. No testing for you.
Yeah, hopefully that'll be one day soon, Danny. But I do think it's actually really interesting that you're having the UK talking about the removal of travel restrictions. And in places like Asia, it's just more restrictions going into place, Hong Kong and Tokyo, for example. So it really shows the policy divergence depending on where you are in the world. As for what I'm watching here in the United States, in New York, it'll be Fed Minutes at 2 p.m. Eastern time. We obviously know the decisions they made in December to double the pace of tapering, to drop the word transitory. Now there's 3 hikes for this year on the dot plot. But the language around how they were viewing when rate liftoff would be appropriate, what criteria are they looking for, and also did they talk at all about when they're going to start running off the balance sheet? I think those will be really interesting insights that we could get in these minutes, Anna.
Yeah, absolutely. So lots to watch out for when it comes to those minutes, even though, as we've said before, so much has happened, it seems, since then. I'm going to be watching a visit by the German foreign minister to D.C. Annalena Baerbock, who's the relatively new foreign minister, is going to be meeting with Anthony Blinken. And of course, this taps into a couple of themes that we cover geopolitically and in terms of markets. Geopolitically, a focus of their conversations will be what's happening on the Russia-Ukraine border. And that taps into markets because, of course, of the role that Ukraine plays in in getting gas from Russia to Europe. Another day, and as we said at the beginning of the show, another day we watch European gas prices go higher. We'd had some respite from that over the New Year period because temperatures here were actually quite mild. But as things look as if they're getting cooler, unfortunately, that does mean that we are seeing energy prices on the rise, and Russian flows to Europe still look relatively low. So we'll watch that meeting taking place for a number of reasons. Also, the German utility Uniper having an enormous margin call. That's a story we're watching, worth keeping in mind, Danny.
I can indeed confirm it is uncomfortably cold in London. All right, well, let's turn to another energy story, specifically electric vehicles. And Ford says that EVs could grow to 10% of the U.S. market this year. Kumar Galhotra, Ford president of the Americas and International Markets Group, spoke with Bloomberg yesterday.
Based on the demand we are seeing for our vehicles and the rest of the industry is seeing, it feels like the demand is certainly there. But the question will be how quickly can we, all of us, execute to build capacity to meet that demand.
And perfect timing because EVs are the theme of today's Bloomberg Big Take. The race to dominate the electric vehicle industry is heating up, and Tesla smashed expectations for fourth quarter deliveries. But legacy car makers, Volkswagen and Toyota, are scaling up production too. Just last month, the companies announced $170 billion worth of EVs. Craig Trudell, Bloomberg Global Autos editor, joins us now for more on today's Big Take. Craig, we've heard countless times that we have more competition with Tesla. Why is now the time we should take them seriously?
I think up to this point, we've largely seen a lot of the competitive models from other automakers really being in the premium segment. You think about Porsche Taycan, you think about Audi e-tron, the Jaguars of the world. What we're going to see this year is a greater scaling up by Volkswagen of the ID models that you saw really coming into full force last year. They're going to be making those at more plants and a wider sort of selection of models in 2022. You've got a case with Toyota where it's a company that has been a bit of a doubter of fully electric vehicles and a company that's tried to really leverage its hybrid advantage. They're getting into EVs in a significant way. You've also got the Fords and GMs in the U.S. market. You've got Hyundai and Kia in Korea really ramping up electric vehicle production. So, Tesla does have a significant lead up to this point, but we're going to see a real sort of wide selection of more mass market models.
So we've been showing a lot of graphics, Craig, that tell that story. Tesla really is in the lead, and no doubt it will fight back. What do we expect? Yeah,
I think with Volkswagen and Toyota, they really have the scale that is sort of unrivaled in the industry. With Toyota really sort of lowering its guard in terms of its skepticism to EVs. It's going to be really interesting to watch just how quickly they are able to scale up. I think the F-150 Lightning is going to be one of the most fascinating products to watch because you have so much built up confidence in that model line and sort of familiarity with it. I was actually back in the States for the holidays and was amazed how much the company is advertising that. So it's really going to be interesting to see how quickly the company can get production scaled up.
Okay, we'll see that scale up in 2022 perhaps then. Bloomberg's Craig Trudell, thank you very much. More Bloomberg Surveillance is ahead. We'll hear from Christian Muller-Glissman of Goldman Sachs. How much asset allocation should be going into, cryptos? That's a story that Goldman has been making headlines around today. This is Bloomberg.